In a world where the only constant is change, your investment shouldn't just survive, they should thrive, no matter what the economy throws at them. Want to know how? Let's dive in. Today we are exploring recession proof stocks. In my last video we discussed Bitcoin and gold. Now, let's talk about something that can be even more crucial during economic uncertainties. Renowned investor Ray Dalio talks about 4 economic scenarios: inflationary growth, inflationary recession, and deflationary recession. Understanding this can be key to picking stocks that stand strong, no matter the economic weather. In this video, we'll break down these scenarios, uncover the strategies to navigate them, and I'll even show you a ChatGPT hack to pick the right stocks for each situation. Let's get started. So, what exactly are these 4 economic scenarios Ray Dalio talks about? And why do they matter to you as an investor? First up, we have inflationary growth. Imagine the economy is expanding, but so are the prices. Think late 90s, tech boom, or the post-war periods. Here certain stocks can really shine. In this phase, companies that can pass on the cost to customers, like consumer staples or energy sectors, tend to do well. But be cautious, not all stocks benefit equally. Next, let's talk about deflationary growth. This is when the economy grows, but inflation is low, or even negative. It's a bit rare, but it does happen. In this scenario, bonds, especially government ones, are your best friend. And don't overlook tech stocks. Lower interest rates often spell good news for them. Now, what if the economy is shrinking but prices are soaring? That's an inflationary recession. It's tough, but not all hope is lost. In such times, tangible assets like gold or real estate can be safe havens. Also, consider commodities. They often hold their value when currency weakens. Lastly, we have the deflationary recession. The economy is down and prices are falling too. Think of the Great Depression or the 2008 financial crisis. Here, high-quality bonds are a smart move. They provide steady income and maintain value. Also consider defensive stocks like those in healthcare or utilities. Understanding these scenarios helps you anticipate market trends and make informed decisions. But how do you apply this knowledge practically? That's what we'll explore next. Alright, we've covered the what, now let's dive into the how. How do you tailor your investment strategy to these economic scenarios? The strategy we are discussing is dynamic allocation. It's about adjusting your portfolio based on which of the 4 economic scenarios you are heading in. For example, in an inflationary growth phase, you might shift more towards consumer staple stocks. This adaptability is key. So why does this strategy work? It's all about flexibility and risk management. By adapting to economic trends, you're not putting all your eggs in one basket. In different economic conditions, different assets perform differently. So this strategy helps in balancing your portfolio for stability and growth. Application is crucial. Start by staying informed about the economic indicators, inflation rates, GDP growth, unemployment figures. These are your guiding stars. Then, review your portfolio regularly. Are you too heavy in one area? Might be time to rebalance based on the current economic scenario. Finally, how do you choose the right stocks? Look for companies with strong fundamentals like good cash flow, solid management, and market resilience. Also consider industry trends and how different sectors respond to economic changes. For example, tech might thrive in deflationary growth but struggle in an inflationary recession. In essence, recession-proof investing isn't about finding one perfect stock. It's about having a strategy that adapts to changing economic winds. Now, let's talk about the secret weapon in your investment arsenal, ChatGPT. Wondering how this AI tool can be your financial ally? Let's find out. ChatGPT is an AI language model developed by OpenAI. It can understand and respond to a wide range of queries. But how does this help with investing? You can use ChatGPT to stay updated with market trends, get summaries of financial news, and even for analysis of complex economic scenarios. Let's say you want to know which stocks to consider during a high inflation period. You can ask ChatGPT for a list of sectors typically resilient to inflation. Or, if you are curious about how a particular industry performs in a deflationary recession, ChatGPT can provide insights and historical data. Here are some practical tips. Be specific with your questions. The more detailed your query, the more tailored the response. Remember, ChatGPT is a tool to assist your research, not replace it. Always cross-check with other sources. In summary, ChatGPT is like having a financial research assistant at your fingertips. Use it wisely to enhance your investment strategy. You've got a strategy and you know how to use ChatGPT. Now let's dive into the crucial part, picking the right stocks. First, assess the current market condition. Is it a recession, inflation, or a growth period? Each scenario favors different sectors. For example, consumer staples and utilities often do well during recession, while tech stocks may thrive in growth periods. Next, look at the fundamentals. Check the company's debt levels, earnings stability, and management quality. Companies with strong fundamentals are generally more resilient in tough economic times. Don't put all your eggs in one basket, diversify across sectors. This doesn't mean owning lots of stocks, but owning stocks that behave differently under various economic conditions. Think long term. Short-term market fluctuations can be misleading. Focus on stocks with potential for sustained growth. Choosing the right stocks is a mix of analysis, strategy, and mindset. Stay informed, stay diverse, and stay focused on your long-term goals. Now, let's back up our strategies with some compelling facts and stats. Knowing this can help you make informed decisions. Did you know that during the last 5 recessions, certain sectors like healthcare, consumer staples, and utilities outperformed the broader market? This isn't a guarantee, but it's a trend worth considering when building your portfolio. A study showed that portfolios diversified across various asset classes reduced risk by up to 40% without sacrificing returns. Diversification isn't just about owning different stocks, it's about choosing assets that respond differently under various economic conditions. Statistics reveal that long-term investors, those who hold investments for more than 10 years, have a 95% chance of positive returns. This highlights the importance of patience and the long-term view in investing. What's interesting is that stock markets tend to react 6 months ahead of economic changes, so by the time a recession is declared, the market might have already adjusted. This underlines the importance of staying informed and proactive in your investment strategy. These facts and stats give us a clearer picture of how to approach recession-proof investing. It's about being strategic, diversified, and patient. Alright, let's quickly recap what we've covered today. We dove into recession-proof stocks, understanding Ray Dalio's 4 economic scenarios, and applying a strategic approach to investing. Remember, the key is to diversify, stay informed, and think long-term. And don't forget the ChatGPT hack we talked about. It's a game changer for applying these strategies and staying ahead. If you found this video helpful, please give it a thumbs up and share it with friends who might benefit from it. Got questions or insights? Drop them in the comments below. I love hearing from you. And if you are new here, don't forget to hit that subscribe button and turn on notifications. This way, you won't miss out on more videos like this. Stay motivated, stay focused, and I'll see you in the next one.